All right, producer price inflation numbers due out in the next 15 seconds. Let's cover what to expect. Keep in mind, we now offer licensed financial advice at stackhack.com. Get stacked with StackHack, linked down below. PPI final demand is expected to be 0.2, core 0.2. And what do we get? All right, headline number actually comes in a little hot, 0.3. Not so great for that disinflation narrative. PPI X food and energy, that's your PPI core, comes in at 0.3. That's 0.1 hot. We got a little bit of a hot read here on PPI. Not great. Probably going to help push stocks down lower here. We just got PPI X food and energy and X trade at 0.2. That matches the 0.2 that we were expecting. Year over year, though, comes in a little hot. Year over year expected to be 2.3, comes in at 2.4. Year over year, X food energy trade expected to come in at 2.5, comes in at 2.7. We also have revisions that come in higher. PPI final demand year over year coming in at, the prior was revised to 0.2 versus 0.1, so a slightly up revision. And then PPI X food energy trade year over year coming in at 2.7 versus the prior of 2.6. Pretty much everything just got ticked up. Not great. The only thing that actually got, oh my gosh, these numbers are all, what the hell? These numbers are all over the place. Okay, PPI final demand month over month gets revised last month from 0.1 to 0. So it gets revised down. And then get this, PPI X food and energy month over month goes from 0.1 to negative 0.1. So this is kind of like bad news last month, good news the month before, but it's a month late. Weird PPI report here. I don't know that, and we'll look at the actual report here in just a moment, but we're definitely seeing, some of what we would expect, minor red candle popping up right away on a NASDAQ. Obviously, it'll take some time to see how this actually ends up playing out. Those prior revisions to the downside may be setting the basis for these higher results for this PPI read. But producer price inflation is usually a tool that leads to consumer price inflation reads. And so we like to see PPI come in low. Unfortunately, in this case, it looks like we beat some of the estimates just by about 0.1%, as well as having some revisions to the upside, but also some revisions to the downside. So a little all over the place. Let's see if we can actually go into the report and see what the contributors here were for a slightly higher PPI report. This isn't great, though. This is once again going to reiterate what your Mary Daly suggested from the Fed, which is we still have work to do on inflation. It is entirely likely that the Federal Reserve, in fact, I would call it probable, that the Federal Reserve knew PPI numbers were going to come in a little warm, and that's why they ended up a little calm after those CPI numbers yesterday. And they refused to be excited about the CPI numbers yesterday. That would make sense. The Fed does have the ability to get some of these reports sometimes a day, sometimes even a weekend before we as the public get these releases. Creates probably a good opportunity for them to trade. Obviously, they say they don't, but so shouldn't be so jaded, Kevin, here. But let's look at the actual PPI report. Producer price index for final demand increased 0.3%, seasonally adjusted in July. Let's see what contributed here. This was driven by a 0.5% rise in the index for final demand services. Services, that's that sticky area where people are a little nervous potentially about, oh no, is that going to continue to contribute to inflation sticking around for much longer? Let's see, final demand up 0.5%, the largest increase since August of 2022. Leading the broad-based advance in July, prices for final demand services, less trade, transportation, and warehousing climbed 0.3%. And final demand services margins rose 0.7%. Product detail, 40% of the July advance in the index for final demand services can be, traced to a 7.6% rise in prices for portfolio management. Indices for machinery and vehicle wholesaling, outpatient care, chemical products and wholesaling, brokering, investment advice, transportation also moved higher. Margins for food and alcohol retailing dropped 2.5%. That's interesting. So really, some broad-based producer services pushes here on pricing. Not great as sort of a leading indicator for inflation. Maybe being a little bit more bumpy on the way down. This is leading our 2-year treasuries and 10-year treasuries to pop a little bit, and of course is leading stocks algorithmically and understandably to slightly move a little lower. We have bonds right now at the 10-year treasury jumping to 4.135. Still lower yields than where Mr. Ackman shorted the Treasury market, but definitely still elevated. Long-term inflation view means the Fed's not done yet. Well, yeah, no kidding. And this sort of contributes to that. This is, again, why I'm thinking the Fed's going to stay higher for a lot longer than, unfortunately, we really believe they would. Final demand goods, prices for final demand goods edged up 0.1% in July. No change in June. July increase attributable to final demand for foods, which rose 0.5%. These are some of our leading indicators here. Not so great. Let's see if we can get a little bit more into the weeds of some of this data, as well as keeping an eye on commentary here from Wall Street. We have, really, I think the belief that the Federal Reserve probably had a heads up on this report, hence their hawkish commentary yesterday. All right, let's get into some of the final demand numbers and see specifically where some of this pain is coming from, and that'll give us maybe a little bit more insights here. All right, let's get that imported. All right, while it imports, I'll start popping over and going through it. Okay, so here we go. So let's see here. Where are our rises? June to July on the far right side. Final demand for food, 0.5%, not great. Energy, 0 on PPI once you factor in all the averaging out. Fine. Final demand services. Look at where we've been with final demand services. We've been at negative 0.1, 0.2, 0.2, negative 0.1. Boom! All of a sudden an explosion to 0.5. That is a much higher than expected services read. Not good. This is the one place we really didn't want to see a warm read. Apparel wholesaling, paper, all of these going negative. We've got TV, video, photography, equipment, negative. We've got sporting goods and lawn and garden care. These are up. Hardware and building materials up 5.6%. This likely because of the construction boom that you're seeing in real estate right now, where a lot more home builders are building a lot more aggressively because of the shortages of housing and elevated housing prices. Consumer loans went negative. Portfolio management. That's incredible. That's when financial advisors actually take people's money in sort of the phrase is called AUM, right? Assets under management. They actually take people's money and manage it for them. And portfolio management exploded here, 7.6%. Wow. Tax prep services, also a little bit of a pop here at 1.6%. We've got, let's see what else here. This is a nursing home care up 0.6%. Hospital outpatient, 1.7%. That's 0.7%. Look at this. Arrangement of cruises and tours, so like a travel planner, up 1.5%. Arrangement of vehicle rentals down 1.5%, but arrangement of flights up 1.3%. Tax prep, we already covered, up 1.6%. So really a lot of some of those core producer prices actually trending up a bit. You've got travel accommodation services in the intermediate demand negative, but again, that's going to be more of like your actual hotel service rather than the arrangement service. It's almost like services for services are becoming more expensive. Interesting. Okay. What else? Aircraft's always been expensive. Non-residential property management fees up 5.2%. Good Lord. Hardware, building materials up. We already covered that. Okay, so it appears that what you've got here in the PPI numbers are, unfortunately not good news. Unfortunately, some of those core services, whether it's financial related or travel related, or property management related, building related, aircraft related. Some of those core services are seeing a little bit of a spike. Now, it's possible that, as they always say, one report doesn't make a trend, but hey, maybe that's sort of like some of the volatile back and forth stuff that we get every month. But it's definitely something markets are going to consider a lot more than a benign PPI report. We've actually been very used to just getting very benign PPI reports where PPI is stable to down and always seems to come in softer. The fact that now it's coming in hotter than expected on almost every accord, the only thing that's coming in softer are the revisions for last month, which, big deal. The current data is a little bit more aggressive. It's going to leave people a little bit concerned and maybe a little bit gun shy again, especially regarding those interest rate sensitive sectors, automotives, solar, growth trades. Those are going to likely get hit harder as we still try to figure out, is inflation actually gone? In many regards, we expect it to essentially trend towards zero. The problem is it's not a straight line to zero, it's a bumpy line to zero. And it's that bumpy line to zero that actually has a lot of bears really concerned that, look, it's not inflation is here forever, it's going to stay forever. It's inflation's just going to take longer to get down. That's going to leave the Fed aggressive for longer. And with an aggressive Fed for longer, it's going to take longer to get those rate cuts. Maybe they'll come right before the election. Still think that's true. But a bumpy report like this will definitely reiterate that. All right, this isn't going to be straight down. With the exception of maybe the stock market, which could be straight down. I don't think that's particularly likely. I'm saying that mostly facetiously. But I do think it is very natural to see a little bit of an accelerated decline on the retracement here. Unfortunately, though, for the NASDAQ, an accelerated retracement here beyond the 373 level is not great because it sets us up for the next retracement level sitting at 348. And I don't particularly love where this chart is sitting right now because it does indicate that we have somewhere around another potentially 5% drop ahead of us on the Qs. And unfortunately, you're going to break more retracement channels. You could see the same thing here on Tesla, rejecting almost perfectly at the 300 retracement level, breaking right through the 258 as we just continue to extend this drag on the bearish narrative that, hey, the Fed's going to end up overdoing it. And so that's really what we're seeing here. Obviously, we've had a phenomenal run since about April, where it's almost been every single day we've seen the market green. Yesterday, Tesla was up 1.3%. Today, pre-market, it's down about 1%. Enphase yesterday down 1.4, down 0.7 now in pre-market. Q's rotating down. Let's take a look at Apple here just to see how some of these megas are moving. Apple down 12 bips yesterday, only about 4 bips right now. Obviously well off its highs of nearly $200 per share. MSFT, same thing here, well off its highs of 366, sitting down at its next fib retracement level. And you jump on over to NVIDIA as well, and you can see NVIDIA is getting rejected by the extended fib level, and it's now in a no man's land, potentially setting up to trade right back down to about 346, which wouldn't be great. So keep an eye on this. I do think this will probably be still, there's still some legs to sort of this bear market, adjustment that I think we're going through before we get any kind of more confidence that, okay, we can start pricing in Fed pauses and maybe Fed rate cuts. So in other words, probably still a week, 2-3 weeks to go of pain. August might still be a bit painful. We'll get Jackson Hole. I think Jackson Hole from the Federal Reserve will be very clarifying for markets. And hopefully that leads into the pause narrative and the eventual cut narrative where we start seeing some softening from the Federal Reserve. You can actually see what looks like a pretty nasty double top here for Trade Desk. Trade Desk ran all the way up to about $91. This has been sort of a stealth trade. I've had exposure to this as well, and it's been a stealth trade that has just been riding up. But here, just in the last couple weeks here, since about that July 19th peak. We've seen a bit of a correction back down to next fib level. And the question now is, do we break these next fib levels of support, or are we going down even further? Today's PPI inflation data, unfortunately, extends the possibility that we might still be in a little bit of a bearish environment for a little bit longer. So let's take a look at how the bond market is now reacting. Bond market, we are looking at sitting at almost 4.14 on the 10-year Treasury. Keep in mind, Bill Ackman shorted Treasuries when the 10-year was sitting at about 4.2%. When yields are higher, it means prices are falling. So that actually means prices rose a bit since Ackman's short. So he's kind of upside down a little bit, not much. And there's this idea that from Bill Ackman that yields are actually going to rise a lot more, leading prices to fall more and then Ackman to profit. Right now, a lot of folks, though, are looking at this and saying, well, here's my opportunity to load up on Treasury bonds, because between now and when the Fed finally realizes they have to aggressively cut, you'll probably see a massive bond market rally. And so that's leading a lot of people to get very excited about potentially getting into bonds as quickly as possible. So that's an idea if you can, hold out to probably next summer to fall, right before election timing, for some serious rate cuts. And then, of course, the question then is, will we be in a deep, dirty recession by then? And that's the big old TBD. So that does it for PPI data. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by artificial intelligence. If you can master AI by starting on the ground floor, let's go.